Hello, my name is John Wilson, and welcome to today's webinar on mastering private credit. I'm a director here at the Global Institute of Credit Professionals, and we're joined today by my colleague Philip Waddilove. So, Philip, over to you for a brief intro.
Hi, good morning, good evening, good afternoon. Thanks very much for joining us. So my name is Philip Waddilove. I'm one of the faculty members here at Fitch Learning. And today we're going to take a little look at private credit. We've done a little bit of work around skills mapping, taking a look at some market data, and we're going to walk through that, give us an opportunity to talk to each other and maybe to even to ask some questions towards the end. Yeah, that's the format of the day, I think, isn't it, John?
Yeah, for everybody who's joined us via Zoom, we're going to have the question functionality open through the whole webinar. So do feel free to put those in as and when they come up, and we've got time set aside at the end for a Q&A. I think the best place to start would be if you can give us a bit of an overview of the ecosystem as it stands at the moment, both in terms of the corporate banking world and direct lending and how those are currently interacting.
Yeah, sure. So a little bit about my background. I spent 15 years working in corporate investment banking, and often, particularly towards the end of my career, when I was working in sort of a corporate finance capital structure advisory function, I found that we were increasingly competing with private credit providers. So it's a particularly interesting topic, whichever side of the fence you sit on. Let's take a look at our first slide here. What we've got is a schematic, really, market structure. So a look at how investors may have traditionally accessed borrowers and vice versa. On the right-hand side, we've got the traditional flow of events, if you like, investors seeking cash, seeking something, either to make an acquisition or maybe to finance some capital expenditure. And the traditional method would be to go to their friendly corporate or investment bank and ask for a loan or a bond, help with bond issuance, particularly if they're a large corporate and they were looking for sort of high volumes. And their friendly corporate bank would help them do that. They would either, get out their Rolodex and call their favorite investors and ask if they were interested in helping this borrower raise money through a note or a bond, or the bank would take it upon themselves to lend directly to the company. And these would typically be sort of loans, term loans. They might include revolving credit facilities for working capital and things of that nature. Investors on the other end of that spectrum were seeking returns for their cash. So just in the way that you and I have savings accounts, corporate investors or sort of institutional investors would be actively seeking ways to deploy their capital and talking to their banks. So the banks would really act as a conduit, connecting borrowers and investors. So a couple of things happened really in the last 15, 20 years. So post Great Financial Crisis, a couple of things happened. We went into a really low interest rate environment. So investors weren't really happy with the kinds of returns that they were seeing for a lot of the cash that they had available to invest. And so they were seeking yield. They were on a hunt for yield. So a lot of money was now being diverted, increasing volumes of cash was being diverted towards private markets being both private equity and now private credit. Private markets is kind of the umbrella term. So low rate environment pulling investors towards more esoteric, slightly riskier investments, quite honestly. And then there was a push factor, and that push factor was around the regulatory change that happened as a result of the Great Financial Crisis. Globally, that's often called Basel III. More locally in the United States, some of the Dodd-Frank legislation contained capital requirements, particularly as it pertained to sub-investment grade issuers. So these are slightly riskier propositions. Maybe these are companies that are new, they're emerging, they're growing quite quickly. They may be for leverage buyouts, and in fact, a lot of that market is now being sort of shifted towards private credit. Yeah, but the capital requirements, the cost for a traditional bank to hold a loan to a sub-investment grade business blew out, and in fact, we can see that almost doubled. There is a quote, I think, in the next page, which we'll get to. So a lot of this demand and supply shifted from what you might call the traditional route to this new sort of framework. So now we've got this position where traditional banks, and in fact, I was sitting on the right-hand side of this slide, we were competing increasingly with providers of private credit. So it's an interesting sort of innovation. And general partners now on the private market side are sitting on something between $3.5 and $4 trillion of quote unquote dry powder, which they can choose to deploy as equity, or they can in fact contribute it to private credit. So there's a lot of demand for this sort of paper at the moment. So we've got something here from ISDA. This is the body that in particular is concerned with trading over the counter. So coming up with documentation that can be used to facilitate over the counter trading arrangements. They did a study around the capital requirements, and based on their impact study on Basel III, their estimate was something like a 73 to 100% increase, so a doubling effectively of the capital that they had to set aside. So that's the big push. Banks not no longer wanting to invest or lend to sub-investment grade propositions, finding it more difficult to justify it in their credit committees, basically.
And so if we look at the other side of the equation, can we look at why borrowers might be opting to tap the private credit markets rather than syndicate markets? What those sorts of drivers are?
Yeah, great. So for borrowers report or have reported in the past a few factors. We've collected those terms here. The first one is greater closing certainty. So this is perhaps a function of dealing with one, maybe two lenders in the private credit space, as opposed to a syndicate, maybe a syndicate of 10, 20, in some instances for very, very large loans, even 30 or 40 banks. There's a great deal of uncertainty with regards to the volumes that might be achievable. So greater closing certainty of the volume that you might require. And you can imagine that if you're a general partner and you're running a leverage buyout, you need closing certainty. You need funds available on this date, this closing date, and there's no room for ambiguity. It's difficult to be in limbo for the month or 2 months that it might take to arrange and syndicate a loan, when both the volume, so the amount of money that you might raise, and the pricing as well could be uncertain. So two big advantages to a borrower: greater closing certainty of the volume that you're looking for, and also pricing as well. You're very, very clear at the early phase of a transaction what the pricing is going to be, because again, the borrower is really only dealing with 1, 2, maybe 3 lenders from different private credit funds,
although not necessarily cheaper when we're looking at the pricing side of things, right?
Absolutely, yeah, that's right. So loans that end up in these private credit funds are typically not traded. There's not much of a secondary market for them, so there does tend to be a liquidity or an illiquidity premium associated with those, and that's something that providers of private credit are very aware of, and they will build into their pricing. It's quite likely that a sub-investment grade borrower is having trouble accessing the volumes that they need in the broadly syndicated loan market, and that may be why they're now talking to a private credit provider, and private credit providers are aware of that. Having said that, recently, and maybe there'll be time to sort of touch on this in a little bit, but interesting tactic being employed by borrowers. Now they're aware that there is this sort of other pool of capital that they can access, starting to play off the traditional route with this sort of newer route. So running what people call a dual track process. They will essentially put their banks in competition with private credit providers. And that has the effect of creating some pricing tension. So we have seen some deals repriced, so private credit deals repriced more keenly once the private credit provider gets the sense that they're in competition with the broadly syndicated loan market. However, typically there is an illiquidity premium, not much of a secondary market for this paper. Whereas for sort of term loan A, term loan B in particular in the United States, yeah, there's a very, very active secondary market. A few other things on here, faster deal execution. Yep, if you're dealing with one or two lenders, you can expect to execute your deal fairly quickly. Typically, it's 1 to 2 months for new money in the broadly syndicated loan market. That's particularly true in Europe. In the United States, the timeline is a little bit compressed, but still deal execution, that's another advantage that borrowers have identified. Confidentiality. Yeah, so particularly if you think about a large merger, which requires a lot of financing, and you're dealing with a syndicate of 30 or 40 banks, the opportunities for leakage are just greater. So that's an advantage. Leverage, yeah, well, we're talking about leverage in the negotiating sense, but what we'll see is that that leverage multiples, so debt to EBITDA multiples out of the box for a borrower can be more attractive potentially in the private credit market. Private credit funds at the moment seem comfortable to take on a little bit more risk, perhaps because they don't have quite the same capital requirements as the banks. And the last one is negotiated terms. So another feature of the private credit market is that the borrower and the lender can talk at length for a long time about financial covenants, what other restrictive language there might be. So restrictions on EBITDA add backs, if you're looking at an LBO, for instance, basket language, what sort of assets can the company sell, what sort of distributions can the company make to shareholders, etc. And other potential leakages. So that tends to be highly negotiated in a private credit document. You know, by the nature of a broadly syndicated loan, terms have to be fairly standardized. You know, they're sort of commoditized or homogenous, and they have to satisfy, broadly speaking, a syndicate of, you know, 20 or 30 banks potentially. So yeah, so that's a bit of a rundown of the benefits to borrowers.
And then I thought next we could do a deep dive on how the direct lending market has sort of evolved over the past few years. I think we've seen some fairly significant growth, and it would be good to know what that looks like in the broader context.
That's a good question. So let's look at this chart on the left. So we've got direct lending assets under management, and we've got that versus traditional market. So traditional pools of capital to support sub-investment grade businesses is on the left-hand axis, and then we've got direct lending, which is a subset of private credit, on the right. So we can see pretty clearly that direct lending as an asset class is growing almost exponentially, has been growing almost exponentially. It's not quite at the same size as these two sort of other traditional forms of capital. So if you look at high yield corporate bonds and then leveraged loans, so that would be your term loan A, term loan B, pro rata facilities that a bank might arrange and syndicate for you for a leveraged buyout, for instance. So those volumes have grown a little bit. Looking at these numbers, it looks like direct lending assets under management, it's what, 3x since 2019, something like that. So that's going to be over 30% annualized growth rate versus, I don't know, sub 10% growth rate in the other two asset classes.
If we look at those asset classes at the moment, I mean, looks like leveraged loans do have a bit of growth, and you know, you average things out, probably high yield is pretty much flat. Do you think that the growth in direct lending has come directly at the cost of, you know, one of those other asset classes really growing, or do you think it's general sort of increased volume in the market and it can actually sustain further growth?
That's a very, very good question. Yeah, assets under management, if you think about the dry powder number that we looked at before, that's capital that's being waiting to be deployed. So it's been there's been a subscription period, capital has been committed, to various funds, either private equity or private credit, and that's being sort of held back, and general partners are looking for opportunities to deploy that. So there is some sort of secular trend towards increasing volumes of both equity and credit supporting private market investment. So there is some secular growth. At the moment, it doesn't appear that direct lending is eating the lunch, quote unquote, of the traditional, leverage loan and high yield bond markets. But I mean, looking at that trajectory, it's hard not to imagine that there may be an inflection point somewhere down the line. Yeah, very, very good question.
We've had a question come in from somebody who's pointed out, I think they're probably right, that these are likely to be billion rather than million. We've got the
yeah, that's right. That's
yeah.
right.
So I think that the key might just be 1 decimal point off there.
There we go. Yeah, let's annotate that. Well, these should be billions. Very good question. Very good point. Thank you very much. Yeah. What's the next one? Okay. Yes, we've got another one. So we've got direct lending by region. It's concentrated in North America. There is good growth in the European Union. I think that sort of makes sense. Most of the private credit providers are, large general partners, sponsors, like Apollo, Ares, Blackstone. Blackstone's running the largest private credit fund in the world at the moment. And these are all North American. They've got lots of US dollars to play with. And so they're seeking sort of the low-hanging fruit. They're investing in local propositions first.
And I mean, when we look at rest of world, is there just no appetite at the moment? And do you think there's significant room for growth, or is it the case that really we're going to focus on North America, Europe, and that's where the market will mature and stick to what it knows?
I definitely think that there's scope for this kind of asset class to support propositions in the rest of the world. For the most part, these loans are documented under sort of North American conventions. So wherever you're raising money, you have to be comfortable with New York law. You have to be comfortable with the way these documents are drafted by an American law firm, basically. So if you can get comfortable with that in Malaysia, then that's absolutely fine. And I think that may be one of the reasons why volumes aren't quite so high in these regions at the moment, is because the market was sort of has developed in North America and conforms to North American market conventions.
Cool. So I think next it would be good to sort of look at the composition of assets within the funds and really get a handle on that. What we're expecting. We've still got the annotation on that. But what we can expect from that side of things.
Yeah, so looking at credit quality of fund assets, so we've got a couple of credit metrics, very common credit metrics here. Coverage, so interest expense, or EBITDA as a multiple of interest expense on the left-hand side, and then leverage, so debt as a multiple of EBITDA. Two very, very common credit metrics associated with corporate lending. And they're very common maintenance financial covenants as well. And we can see that the average coverage of the assets in the funds that our partners at Fitch Ratings and CreditSights cover, the average coverage is around, well, just under 2 times. That's the latest information that we've got available. And the leverage associated is just a shade under 6 times. So if you compare that to your average book of corporate credit, investment and sub-investment grade at most corporate banks, these are substantially tighter. So, and I would associate these ratios with things like leverage buyouts, maybe even some sort of second lien type loans, mezzanine type finance as well. There are funds that specialize in distressed situations as well. So there could be some of that in here too. And those leverage multiples are enormous. But in general, yeah, we can see that there's been a little bit of a deterioration in the coverage numbers associated with these. I think really most of the facilities, the loans that are in these funds, pricing that's tied to SOFR these days. Used to be LIBOR, but now SOFR. So as interest rates started to rise precipitously in 2022, the EBITDA coverage of that interest expense fell quite markedly. But it's stabilizing. It's over 1.5 times, which is good. And then these leverage numbers have gone up a little bit. An interesting question might be, why the spike in 2022? And I think that's a mix of pent-up demand. So general partners waiting for markets to stabilize in the wake of COVID. So choosing to deploy that capital again in 2021 and 2022, trying to maybe get ahead of the interest rate rise. And also the higher valuation environment for a lot of these propositions, particularly in the leverage buyout space. So a movement in valuations higher means that in order to support your buyout, you need to put in more debt, and more debt really means higher EBITDA multiples associated with it. Yeah. So some interesting stats there. And in terms of skills mapping, very, very important, isn't it? Because if you're dealing with leverage propositions, companies that don't have a great deal of headroom in terms of coverage, and there isn't a great deal of headroom in terms of leverage, your credit monitoring needs to be really robust, really robust.
I think we'll come onto that sort of side of things when we're looking at the skills gaps. Where do we really need to be focusing energy? So if we're looking at the private credit and the broadly syndicated loan markets at the moment, I think it's fair to say that we've seen some shifts in terms of deal terms and portfolio composition. Can you give us some background on what the main changes that you're seeing in how lenders are structuring deals and generating returns?
Yeah, okay. So let's look at structuring deals. So we've got a measure. This is quite a good measure. This is from our partners at CreditSights. And one of their very clever analysts, or a group of their very clever analysts, have done some work counting the number of covenant light new money loans in the broadly syndicated loan market versus the private credit space over the last several years. So the immediate inference here is that private credit terms are tighter for borrowers. There are fewer cov light situations in private credit than there are in the broadly syndicated loan market. And maybe that makes sense. I think the broadly syndicated loan market is by nature a fairly transparent, very competitive market. You've got banks competing with each other to win a mandate, to win the opportunity to syndicate a deal. And so they're offering very, very borrower-friendly terms in general. And the market convention has been towards covenant light or even, no covenant type situations. Particularly, for investment grade businesses, cover light, no covenant is pretty common. But for sub-investment grade propositions, it's rarer. And since private credit seems to be disintermediating the sub-investment grade space, it sort of makes sense that there are fewer of those cov light or no covenant situations. If we have a look at, I think that the related point, I suppose, here is around default rates, which is an interesting one. And default rates look broadly similar based on the data that we can see. And again, that's with the help of our brilliant colleagues at Fitch Ratings and CreditSights, some excellent analysts and research being produced by both of those businesses. So default rates are broadly similar at the moment. The caveat is that loans that are being raised, new money that's being raised by newer closed-ended funds, they're still pretty green. So these companies haven't had time to run into trouble yet. Be interesting to see, in the years hence, as these funds mature and as these loans reach maturity, whether those default statistics change or not. And the other paradox is that, if you look at the broadly syndicated loan market, if you've got no covenants in your agreement, how do you default? Unless there's a liquidity event and you run out of cash, then there's no default. Whereas at least with some financial covenants, there is a risk of default.
So someone's jumped in with a question which I was about to pose to you as well, and they've said the uptick in 2024 suggests pressure to put money to work, and we can see it on both sides of the market. So I think that's a really good assumption. But if you could elaborate, that'd be great.
Yeah, pressure to put money to work. I think a lot of this has to do with the moderation of the interest rate environment. So rates were rising, and then they plateaued, and now there's a sort of a slow glide path downwards. And I think that sort of means that there is a little bit more certainty. Of course, the tariff situation is a point of volatility, but certainly in terms of interest rates, the way the economy is looking at the moment, there may be a recession at some point in the next, 18 to 24 months, but there has been this desire to put capital to work. The interest rate environment has been benign for just about long enough now for investors to get comfortable in this moment. That may change. Who knows? Let's take a last look here. Point of potential concern, not concern yet, potential concern. The amount of payment in kind interest income as a percentage of portfolio interest and dividend income from private markets portfolios. Okay, so some of these loans might be structured as sort of deeply subordinated loans, so they could be preference shares, so they might be classified as dividends, but you can think of them as deeply subordinated loans. The amount of payment in kind, so the amount of capitalized interest that's being accrued but not paid, and this is totally fine. It's not an event of default. It's in the loan document that a company can do that. That's ticking up, and that may be a signal of a couple of things. One, increase in competition amongst private credit providers for deals, so making more favorable terms. To the extent that this PIK language is structured as a toggle whereby the borrower can switch it on or off, and they're electing to switch it on, that may be a sign of future distress for the borrower. So this number has increased quite significantly, and it's not maybe an issue at the moment.
This is it. I think it's this is something that we'll see in 5 years. What the effect has been, and whether it was just the case that it was a case of freeing up cash flow, or something a bit more sinister.
Absolutely right. If you're looking at leverage buyout, having a PIK toggle is great. It means that you don't need to pay your interest until the business is sold, at which point you've presumably got quite a lot of cash, so you can pay your interest at the end. But if the composition of the portfolio includes regular corporate lending, that may start to look a little bit unsettling, perhaps. Yep. So not super bad issue at the moment. Could be an issue, particularly if that number rises significantly, I would have thought.
So we've got another question. I'm going to answer it tangentially, and we will come back to this fully in our Q&A. But if we think back to the earlier slide on capital requirements, I think it's pretty fair to say that the regulatory environment at the time might have had a sort of hand in building this demand in private credit. So it'd be great to look at that, and whether banks are still participating in the market by proxy. Okay,
yeah, absolutely right. Let's take a look at that. That's an excellent question, and a sort of foreshadowing, really, of I think what we wanted to talk about next, if I'm remembering rightly. So we've got this slide here. Banks are finding the back door to exposure. So we've got a chart here on the left, again, courtesy of our colleagues at Fitch Ratings, looking at this is credit provided by banks, and we're looking at different sectors. So the way banks are deploying credit to different sectors. Credit could be in the form of leverage, so loans, term loan A, It could be in the form of undrawn credit, revolving credit facilities, overdrafts, other capital commitments that banks make to their borrowers. And the collection of rather flatter lines at the bottom, these are the sort of the more traditional sectors or industries that a bank might lend to. So commercial and industrial is a sort of a light pink line. Commercial real estate is a red line. And then we've got this sharp spike, the blue line, NBFI, so non-bank financial institutions, of which private credit funds are a subset. So non-bank financial institutions can encompass a load of things. One of those things it does encompass is private credit funds. So there is the suggestion, perhaps, that banks are finding a backdoor to exposure to these sub-investment grade propositions. The capital requirements are too onerous to have them on their own balance sheet, but they can provide funds and facilities to the private credit funds that do finance these companies. So let's take a look at how they might do that. So they provide funds often in the form of NAV loans, so net asset value loans. In essence, that's taking the value of the collateral in the fund, so the loans that sit in the fund as collateral, or at least a benchmark, and then leveraging that fund. So giving the fund more cash to play with, go and originate some more loans along the same lines. So on a borrowings to assets basis, you know, the vast majority of the funds that we have sight of are operating, you know, just over sort of 1.25, almost 1.3 times net asset value. That's okay. I think the regulatory requirement for most of these funds is around 2 times, depends on the structure of the fund, but 2 times is a good rule of thumb. So yeah, although there may be some risks inherent in this business, you know, direct lending is still quite a small percentage, really, of the overall capital markets requirements for corporates. That's one mitigating factor. And the second mitigating factor is that, yeah, the leverage of the funds themselves doesn't look too high at the moment. If there are lots of serially correlated defaults at some point in future, this leverage number, this borrowings to assets number could spike. We don't have good sight of that, unfortunately.
And that sort of speaks to the second half of a question which we had in the Q&A. So somebody had asked whether we see coming capital requirements similar to Basel 3 or 4 in the industry, and it sounds like at the moment it's not considered enough of a risk to shake it up essentially by introducing requirements like that.
Yeah, there are some regulatory requirements which do catch private credit funds. That that sort of loan to value or sort of net asset value, loan to net asset value leverage number of 2 times is quite common, and I think it applies to funds that are structured as business development companies, which a lot of the funds that have been established in the United States are established as business development companies. So if you're a business development company, you can't run leverage in this sense over 2 times. We don't see evidence of that happening at the moment.
Let's have a quick summary of what we've looked at. We can briefly look at the sort of skills side of things and where we're seeing some potential gaps, and then hopefully we've got time for questions, and I'm sure that we can stick around for a little bit longer if people do want to as well.
Yeah, absolutely. So yeah, private credit is no longer niche. It's a credible alternative to traditional bank financing. So, you know, whether you're working on the buy or the sell side, I think it's important to have an understanding of the asset class. If you're in, you know, fundraising, so if you're in the origination side of any of these businesses, or if you're in the credit analysis side of any of these businesses, it's an asset class that we need to know about. In terms of asset types, we didn't really touch on this, but beyond direct lending, private credit is now extending into asset-based finance, NAV lending, which we just saw, infrastructure credit. Yeah, and I know that you know, risk management, so net asset value lending is not typically covered in a traditional credit course. So we have structured a course. We put a course together which does cover these topics in some greater detail. Heightened regulatory scrutiny, we did touch on that around governance and portfolio risk analysis. Yeah, so we need to understand what the regulatory requirements are around these things. And in particular, when we're looking at like a term sheet for a fund, what regulatory safeguards might be in it. And that's useful if we're looking to finance these funds. Let's say working for a bank and you're looking at a fund financing proposition. Shift towards retail. Yeah, so there's an increased retailization of the private credit space. So yeah, enhancing our knowledge institutionally, I think is quite important. And then competitive pressure. So whether you're working for a fund manager or for a bank, having an awareness of who you're in competition with has to be a good thing. Let's just spend 2 seconds talking about skills mapping. So we've done a lot of talk around, what the market looks like, where the risks might be. So for credit analysts, particularly when we're looking at highly leveraged propositions, we need to make sure that our credit risk analysis skill set is up to scratch and up to speed. Portfolio managers, I think, could benefit from exposure to, an understanding or a better understanding of fund financing, how that might enhance our returns. Investment bankers need to know who they're in competition with when they're looking at broadly syndicated loans and high yield markets. Private equity, yeah, and it's another pool of capital that private equity have to play with. And the last one is legal professionals. So these loan agreements are highly negotiated and highly structured. So we do get some inquiries from law firms that are looking to upskill their teams as they're engaged to advise on the legal documentation associated with the asset class. We've got some courses. So this is our current suite of public courses. So from the introductory right the way through to sort of more advanced fund management. So on the left-hand side is the more introductory course that we offer, moving through to a course that really looks at the credit risk associated with the whole ecosystem. So looking at the credit risk associated with the loans that might go in, the direct lending that might go into a portfolio, and also looking at fund financing in particular. And then we've got sort of more sort of top level fund analysis, looking at portfolio optimization, looking at correlations, default correlations, and things of that nature. So really, we've tried here to cover the asset class from a risk perspective, from the very, very granular asset level credit analysis all the way through to fund level portfolio analysis as well. So a good mix of courses. We've got a QR code here for anyone that's interested in finding out more about these. We run several iterations of these every year, certainly in North America and in Europe. And so there's an opportunity to join these courses. We also offer bespoke courses as well to our corporate customers. So let's turn it over. Let's do some Q&A. We've got five or so minutes for Q&A. As John mentioned, we will be around a little bit afterwards as well if you have some time and you do have a particularly burning question. So let us know.
So yeah, we've had quite a few come in, and I think it speaks to the audience that a lot of these are focused on the sort of the risk side of things and regulatory environment. So if we kick off with one from VJ, in the current unpredictable financial environment, as well as the riskier private credit lending to sub-IG borrowers, how important and robust are the collateral monitoring functions that are in place right now in private credit versus traditional lenders?
That's an excellent question. And without being inside a private credit fund myself, very difficult to answer. One would expect those monitoring functions to be very, extremely well staffed and robust. And I think, as a, from the point of view, I'm in education, so my not my hope, but I think it would be prudent for anyone that was looking to sort of further their career in this space to look for opportunities around intensive credit risk monitoring, collateral management, things of that nature. That could be a good way into the space.
We've got another one, which is whether we're aware of any trends in ranking of financing, so senior versus mezz for private credit.
Senior versus mezz, yeah, good mix. So there are funds that specialize in sort of subordinated or mezzanine type lending, just as there are funds that specialized in distressed situations. So it really does depend, and in fact there is an incentive, I think, in private credit fund, the providers of private credit funds, to give investors that opportunity to invest at their own risk tolerance.
I have another one, which is whether we can comment on the impact of liability management exercises impacting the private credit market, if any.
Yeah. Okay. So liability management. This is, broadly speaking, a borrower opportunistically going to the market to try and refinance an existing note or facility with something that either has better terms or is cheaper. We've definitely seen instances of private credit funds substantially reducing the pricing on existing facilities when there is a perceived threat that they might lose the deal to the broadly syndicated loan market, and they can reduce the margins on those loans by 100 basis points. So it's material, significant.
We've got another one, which I think is, as with your Fitch learning hat on, will be a great one. What's the best financial model that a private credit analyst should be an expert on? Is it an LBO?
Yeah, I think so. I think having an understanding of maybe not a full LBO model, but certainly debt scheduling. So if you have a look at a full debt schedule, so you can sort of type in those terms to your Google search, debt schedule model, or debt waterfall. Yeah, these are the sorts of models that you should be au fait with, should be familiar with. I think if you wanted to go and work in the private credit space. Yeah.
And then another, I think, quite good sort of Fitch learning one is how sustainability is incorporated into private credit. Are there emerging trends or standards? And I think that's an interesting one, because as far as I can see, there are fewer existing templates out there that people can immediately draw on, right?
Yeah, that's right. Given that the market has sort of emerged, was nascent in the United States, the emphasis on sustainability in general, there's less emphasis on sustainability in general in the United States than there is in Europe. So sustainability linked facilities or bonds in general, it's a smaller market. And there are various, structural reasons for that. One of those reasons I know is that in the recent past, certainly when I was in the market on the sell side, so I was working for a bank, and I was working very closely with our syndication team. There wasn't much of an advantage, at least in the United States, for corporate treasurers and CFOs to issue sustainability-linked instruments. There wasn't much of a perceived pricing advantage or reputational advantage. So for that reason, the market, I think, has struggled to gain traction, and that has bled into the private credit environment as well.
And keeping with the US theme, I think this is the last one that we have for the time being. If there are any more, feel free to put them in, but otherwise we will. This will be the last one. Is whether you think a likely lightening of capital requirements in the US under the current administration would reverse some of their drop in participation in the leveraged lending markets?
Potentially, yes. Absolutely. Yeah. I mean, it takes away one of the big push factors, doesn't it? I think what's likely to happen then is the competition between the broadly syndicated loan market and private credit providers is going to increase. We already see it. We already see that there is that competition, and we see borrowers taking advantage of that pricing tension that they can generate if they approach both at the same time. So yes, any relief in terms of regulatory burden, I think, would put private credit providers under pressure, perhaps to loosen terms, perhaps to reduce pricing. Maybe bring it more in line with the broadly syndicated loan market. Don't know, but that's a great question.
Excellent. I think we've covered off all the questions that we have in the chat. If there are any more, you can email them to us. institute@gicp.org. We'll always be happy to receive those, and we can get back to you. And then on the screen as well, we have our next GICP webinar. That's on the 15th of July, and it is focused. We'll run one in the US and one for EMEA. It's focused on the global credit certificate. So if what you've seen today has been of interest and you're looking to really deepen your credit knowledge, this is a really good way to sort of gain that skill set and to demonstrate it to your peers. So we'd love to see you there. That QR code on the screen will take you to the sign up for that one. Philip, anything else from your side?
No, nothing from my side. Just wanted to extend my thanks to everyone for joining us today, and it's been a very interesting chat, I think, and hope to see you at some point in future, perhaps with the GICP, but otherwise somewhere in the Fitch Learning universe.
Thanks, Philip.
All right.
Thank you, everyone, for joining us today. Really appreciate it, and hopefully we'll see you on the next webinar.